Hello, Alexander here. Chapter 15. This is some exercises um, that I do 4 quick ones. I could always go back and do a problem at a later date. And so I thought I'd start with just PE 15-1A bond transactions. So if you see here, A, so we journalize the entries of the following bonds. So purchased for cash $250,000 bond of Belmont City, 4% interest at 100%, plus accrued interest of $1,500. So we debit investments dash city Belmont City bonds for the 250,000, and we debit the interest receivable to $1,500 because we're still going to get that. But our cash goes out the door of a credit of the two combined. But we'll get that back on the interest. And here's we go. So on B, received first semi-annual interest. And so we debit, I showed the equation, 250,000 times 4% divided by 2 equals $5,000 interest. And so we debit the cash for that amount, but we credit interest receivable that came up here for $1,500 to get that off the books. And the difference between $5,000 and $1,500 is $3,500 will be the credit to interest revenue. And there we go. C, sold $80,000 of bonds at 97% plus accrued interest of $500. So basically, we take the 80% times 0.97, gives us 78,000. Well, actually, it gives us a little bit less than that. But then I added the $500 accrued interest, because that's going to be our cash. So remember, 80,000 times 97% plus the 500 is what we debit. I saved the loss for last. I took the $80,000 worth of the bond off the books at face. I credited the interest revenue for $500, and the difference between this side and this side was $2,400 loss. So we lost on that one. Here, we'll skip right over to the real quick valuing trading securities at fair value, PE 15-4A. So we debit unrealized loss on traded investments because the market value is less than the portfolio value, and then we credit valuation allowance for traded investments for $4,200. So this unrealized loss is going to be on the income statement, probably with other income, and this valuation allowance for traded investments is on the balance sheet right under the investment itself, as it acts like a contra. So it's going to reduce the value of that. Swing it over here, bada boom, bada boom. Stock transactions, PE 15-2A. So on February 12th, we bought 5,000 shares of Midex Company. They're acquired at $25 per share, plus a $200 brokerage fee. So we just times the 5,000 times the $24 gives us 120 plus 200. You always add that in there. The cost of a commission is just added to the asset. It's just you just capitalize it. Because any time the cost is associated with an asset, if it's the cost to acquire it, you add it in. So we got $120,200 for debit to investment, Midex Company stock, and a credit to cash of $120,200. April 22nd. We had a 36 cent per share dividend. So 5,000 shares times 36 cents equals 1,800. Debit the cash for 1,800, credit the dividend revenue for 1,800. And then on May 10th, we sold 34,000 shares at $31 minus a $160 brokerage fee. And you just minus that here, right here. So it gives 123,840. We credit investment mid-company stock. We got that number by timesing 4,000 times 24, the original cost. Gives us 96,000. And the difference is a gain on sale of investment. So we got a gain on that one. Good trade. And then here, PE 15-3A equity method. This is a big one. So we purchased 40% of the outstanding stock a First Alert company for 55,000. Oops, sorry, I put THT. That's the company that that bought, because we bought First Alert. But that's fine. So let's say we did buy. It's the opposite, and we're First Alert, and we bought THT company. Same thing, 40%. So it cost us 155,000 to buy 40% share. On the December 31st, they had a net income of 42,000. We get 40%. So we debit the investment in THT company 16,800. Credit income of THT company for the same 16,800. And then they declared a dividend of 12,000. And paid dividends of 12,000. And then we got dividends of 12,000. It didn't say anything about shares, so I think we fine on that. So we debit cash for 12,000, and then we credit investment in THC company for 12,000, because we actually lost the asset because by giving out cash to us in the form of a dividend, we actually lost the asset weakened. And so I'm thinking, I don't know, I may have had to have, I'm not sure, I think this is correct, because they paid a dividend of 12,000, we may have just gotten 40% of that, but I'm not sure. But that's basically how you do it though, because that's the basics though. Cash and then credit investment in THT company. So thank you. I hope that helped. Feel free, comment, like, subscribe if you would. I like doing these 4 mini ones to get a basis of different parts of what the chapter talked about instead of just one big problem that focuses on one area. But I do like those big problems because they get really detailed. They don't give you the interest, and they don't give you a lot of it. You have to get that by yourself. But thank you, and I'll see you for the next one.